Good afternoon, everybody. My name is Colin Day, financial advisor here at Correct Capital Wealth Management. For many of you, I am your 401k financial advisor. For the rest of you, thanks for joining. We do these kinds of webinars every quarter. I call them, education style webinars during lunch. So we can call them a lunch and learn, I guess. But specifically today, what we wanted to talk about were rollovers. So I call it in, out, and all around because there's lots of different varieties and flavors of rollovers. I helped somebody yesterday move something from a Vanguard account over to Fidelity yesterday, and it really sparked my interest in what we're going to talk about today. And again, as I said just a moment ago, what can be considered a mundane topic, but there's lots of intricacies, there's lots of interesting things we have to consider when we do a rollover. So that's what we're going to talk about today. Now, just as a friendly reminder, this is not tax, legal, or investment advice. If you do have individual questions, of course, please let's consider your situation directly as opposed to just talking in general about financial planning topics. So if you do have questions after this, I hope that you will reach out to me or to the firm and someone will be able to address them directly. Now, for today's conversation, we're going to start with the most basic thing possible, which is just what is a rollover? And then we're going to talk a little bit more about why people do rollovers, the best way to roll over accounts, because this is a very common question that I get. We're going to do some rollover considerations, and then at the very end, we'll have time for questions. Speaking of questions, everybody should be muted. If you aren't muted, please mute. It does help the group better concentrate on the material that I'm going over. If you do have questions during my presentation, feel free to type them in the chat. If it's pertinent to what I have on the screen, I'll address it then. Otherwise, I'll address that at the end. We're a small enough group where everybody should be able to unmute their mics at the end if you do have a question at that time. So without further ado, let's jump into this. So what is a rollover? Well, we want to look up the dictionary definition. A rollover is just movement of retirement money from one account to another. Simple as that. They call it a rollover for whatever reason. I'm not even sure if it's in the IRS publications or in the tax code as a rollover, but it is at least the colloquial term that's used for movement of retirement money from one account to another. Now, the movement itself is a tax-free transaction. We're going to talk a little bit more about the tax reporting implications of doing a rollover, but the movement going from one account to another isn't anything that should generate some kind of tax liability. I say that with an asterisk because we are going to talk about one situation at least where that could result in something, but for the vast majority of folks that will complete rollovers throughout your careers, it is a tax-free transaction. There are a few different kinds of rollovers. The one specifically that we're going to talk about today is known as a direct rollover. And a direct rollover is when an institution that holds your current retirement account is made aware that you would like to move to a new one, likely at your new employer. So if you've got a 401k at your old gig and you're working at a new job now and they offer a 401k plan to consolidate accounts, you say, hey, I want to move my money from this 401k institution to my current 401k institution. So we got two Spider-Mans pointing at each other. They're both basically the same thing. They just maybe have different names or different habits, but in essence, it's the same exact thing. Now, why do we roll over accounts? So there's lots of different reasons, but probably the number one reason that people do a rollover is through consolidation. It keeps your life simple. I remember years ago, I met with a woman who was very early in her career, probably like mid-20s or late 20s, and she had like 5 different retirement accounts. And she was, only working for these institutions, 6, 12 months, something like that, and failing and finding the next gig. And unfortunately, she had just amassed retirement accounts at every pit stop. And so what I did with her was we called every institution and we rolled everything into her current employer's plan. Now, did she stick around in that job? No, she left. We did all that consolidation, at least personally, for really nothing, but it simplified her life because she went from having 5 accounts down to 1. And now the new gig that she has, she only has to go back to the old job and move that over. As long as she does that every time she moves, the consolidation makes her life easier. It also allows you to track your retirement accounts because you have it all in one place as opposed to having them at multiple institutions. You'll also avoid forgetting about them if they're all at the same vendor. Now, ease of access. So you have one login to view everything. One of the things we talk about a lot with folks like yourselves, like participants in 401k plans, is like financial planning software that's built into your programs. So whether you have Fidelity or Principal or Voya or whomever you have, They all have different platforms. They all have different financial planning softwares. They all interpret your information a little bit differently. And so from an ease of access perspective, sure, it's one statement, it's one login that you're doing, but also from the financial planning side, it actually makes your life a little bit easier because you're just interpreting data from one source as opposed to trying to insert data from multiple 401k plans. Now, the last two are, it depends on the organization. So better investments, cheaper cost. So with those types of things, like at least with our firm, with the 401k plans that we take care of, again, if you're one of our 401k participants, it's something we're looking out for you for, better investments. So like our firm, we do quarterly investment reviews where we're looking at the investment options, making sure that, hey, are these appropriate for XYZ company? Should we be changing them? So we're trying to make sure that we have best in class investments to make sure that you're going to get the best possible long-term results. Same thing with cheaper cost. Hey, if this vendor is overpriced, whatever financial institution holds on to your 401k, if we feel like, hey, I think the industry average for this particular type of plan is actually a little bit lower, we can fight for you on that part. But every institution is a little bit different. If you work for a 10-person shop and you're going to go work for a Fortune 500 company, well, there's probably tens of thousands of employees in that particular plan, which reduces your cost significantly. So from a cost perspective, that's one reason why people consolidate, is just to avoid some fees. Now, the best way to roll over my retirement accounts, I debated whether or not I was going to include this on here because these are general rules. Again, I just completed a rollover with somebody in a three-way phone call with him, me, and in this case, Vanguard, to do a rollover. But every firm is going to be a little bit different. And so take everything that we're going to talk about with a grain of salt, because we need to make sure that we are approaching this in the right way. And sometimes we do have to follow their rules. So again, every rollover is unique. Every company handles things a little bit different. Use this as a general guideline. When I say that we try to do this as quickly as possible, what I'm really saying is that, hey, every firm's different. They're going to have their own process. Vanguard quoted us 7 to 10 business days for this stuff to be completed. But it generally takes a couple weeks for most of these things to go from start to finish. So if you are interested in completing a rollover, these are the general guidelines. So if you pay attention to anything in this and you are interested in doing a rollover, maybe take some screenshots here. So number one, if you haven't already opened up the new account, open the account. Can't really do anything unless you have a receiving account to take on the new money, or the old money in this case. So step two, you want to contact your new 401k provider for instructions. So for example, you're in a new job, you've opened up your 401k plan. I would suggest giving a call to that institution. As much as I can help, it's ultimately up to them to receive your money. So I want to make sure that this gets done as quickly as possible. So if we know what their rules are in regards to how to do things, and it's helpful to have an old statement handy on your old stuff too, just in case you need it, you will then contact your old 401k provider. So by this point, you know what the receiving company needs to be able to receive the money, but then you're contacting the old provider to see, okay, what's their rules? Now, in a lot of cases, they're going to be able to do this over the phone, and that's great. Sometimes they're going to send out a form. In some very, very rare archaic situations, they're going to send you paper forms, and that's the only way that they can send it to you. Why? I have no idea. It's 2023. Financial services companies, we should all be able to do this online or at least over the phone at this point. But don't be surprised if, hey, we have particular rules that we have to follow. Sometimes we just have to do it. Now, the last thing I mentioned down there is check to see if there's a fee. It's pretty common that there could be a termination charge for moving out. Could be as low as, $20. I've seen it as high as like $150 or $200. So make sure you ask the question if you think you're sacrificing any money up front to roll over. Then finally, if you have to turn in forms, you're going to turn in those applicable forms and then wait. Again, it could take a week, it could take 2 weeks. Basically what you're doing is you're just setting a reminder on your phone every couple of days to check your 401k plan, see if that money is rolled in. If you don't see it within the time period that was suggested by the company that is sending the funds, you want to reach out to them at that point. After it's received into the account, you want to make sure that the old account is emptied. At that point, we want to make sure that, hey, were any deposits that were owed put into the account late? Or if we're in a situation where maybe there was a residual kickback of different kinds of investments and things that were owed to you and you have a couple cents in the account or dollars, you can always contact the old firm and see if they'll do a residual rollover, meaning they're just taking the small amounts and just kicking it out of there. Or they may automate that process for all I know. But those are the steps. Again, open the account, contact the new company, contact your old company, do whatever they say we need to do, including turning in forms, wait, and then you just want to monitor the old one to make sure that it's completely closed out. And that's it. Again, takes a few weeks, but for most people, it's fairly painless. Now, some considerations for you. So when it gets into why we do the rollovers, there's plenty of reasons why we do. But there's some reasons that we should know at least as to why we might not want to perform a rollover on our old 401k money. So the first one is, once you leave, you can't go back. So once we take the money from the 401k plan, your old employer isn't going to want you to roll back money into it. It would be pretty weird. It'd be pretty wild, right? If you worked for ABC company and now you work for XYZ company and you rolled over your account and you say, actually, I don't like XYZ's investments. I'm going to just move this back to my old job. It doesn't happen, right? It's like breaking up with somebody and then the next day saying like, hey, I'm real sorry about that text message breakup. Do you want to get back together again? That's the 401k equivalent here. So if you move out, make sure that you want to stay out of the plan. Also, you want to check your sources. So this is going to take a little bit of finagling between the two different 401k plans now, because we're talking about your old 401k plan money and the different kinds of sources, and that's what those buckets are: pre-tax, Roth, and after-tax. And then what is available to you in the new plan. So your old plan may allow for all three of those options. Most commonly, it's the first two. It's pre-tax and Roth. After-tax is kind of this old archaic thing that's kind of gone away, but it does exist still for certain plans. Now, your new plan has to be able to receive certain kinds of money. So for example, if your old retirement account offered a pre-tax and a Roth deferral option, and let's say that you took part in that, and you have buckets of money in both of those areas, and then your new job, for whatever reason, they only offer pre-tax deferrals. Well, you can contribute pre-tax, you can move your pre-tax money, but your Roth money is stuck there now. So now you've got only your Roth money left over there. And is that the best place for it? Was it worthwhile to even go through the effort to only move the pre-tax money? Well, you'll have to answer that question for yourself. But it's something that does happen. It's rare, but it does happen where people are moving certain funds and or confused as to what they can do. The after-tax bucket, this is mostly for workers that have been around, maybe working in their 80s and in the 1980s and the 1990s, where after-tax became more popular until Roth became the in vogue option on 401ks. You're basically looking at a situation where you could be moving the after-tax money into a new Roth 401k deferral option or source. So plenty of different things to consider here. This is why it's important to bring in a professional or to talk to your organizations to make sure that you're moving over the right kinds of money. And this is a very common one: tax forms. But I thought this was tax-free. Well, we talked about this at the beginning. Yeah, it's majority of cases a tax-free event to move your old retirement account to a new retirement account. But there is a tax form, especially on a 401k, that will get produced called a 1099-R. The 1099-R stands for retirement. That particular form is just letting the IRS know, hey, I moved this from one qualified retirement plan to another, and that's it. So you'll notice there's on this form a distribution code of G, which stands for rollover. And so that's what you're really looking for on most 1099-Rs. That says, okay, I'm going to punch this into TurboTax. As soon as I hit the number, the scrolly thing where it changes the number as to how much you get back or how much you owe is going to go nuts, and it's probably going to go red. And then you tell them, oh, it's a distribution code G, and they're like, okay, you don't have to pay any taxes in this case. But it's a reportable event. So it is important. Just because you got this tax form and just because we know that it's not going to be an actual taxable situation for you, it doesn't mean that you don't report it. You still got to report it. The IRS can audit you if you haven't turned in this document to say, hey, this is a legitimate document that needed to be reported. You didn't report it. Even though there's nothing there, we're going to say, hey, you done goofed. You got to do something about this. The accidental Roth conversion. So again, I just said that by doing a rollover, you don't actually realize any kind of taxable event where you're going to take money out of your pocket. But there is the accidental Roth conversion that we have to worry about. And so if you move, for example, your pre-tax 401k money and you roll it into a Roth IRA, and this is the thing that does happen, you've performed an indirect Roth conversion. Okay, so what you've done is you've taken your pre-tax money. You've told in your old institution, I want to roll this over to my IRA. They say, well, that's very cool. We'll send you, who do we make the check out to? Make it out to ABC brokerage firm. Okay, they're going to type that up. They're going to send a check over. Now, they're not wise to it. Now, the former 401k company is just going to say, we're sending pre-tax money. They told us it's a rollover. We're sending the funds over. When the money moves over, it's up to you then to deposit into the right account. If all you've got is a Roth IRA, or you talk to an advisor and they said, yeah, we're going to open up a Roth IRA for you. Well, if you're taking pre-tax money and you're moving it into a Roth account, a Roth is an after-tax account. So the movement of money from your pre-tax 401k to a Roth IRA will be a conversion, a Roth conversion. Any dollars that move over is going to be included on your income then. So for example, if you have $10,000 in your 401k, it's all pre-tax, and you say, hey, I want to move this over to an IRA. They're none the wiser. They roll it over. They give you the check. You deposit it into a Roth IRA. You've just realized $10,000 in income. Okay. In that situation, not great. Get money into the Roth account. That's cool. But unfortunately, you're going to be footing the tax bill on $10,000. And it's going to be at whatever applicable tax rate you're at, which may not be the tax rate that you actually want to do this at, especially if you're working. So it does happen. I've seen it before. It's not great. For some people, that's their intention, is to just do that, and that's okay. But for some folks, I just want to make sure that you knew that, hey, IRS is going to know about this, because what they're going to see is a 1099-R for a rollover, and then they're going to show a tax form that has a deposit for the same dollar amount in a Roth IRA. And then they're going to say, dear sir or madam, you owe us some tax money, you're being audited, or whatever happens in that case. You're at least going to get a letter of inquiry at that point. So should I move money out of the 401k ecosystem? So I actually did a video on this recently. If you looked at my LinkedIn about after-tax money in my 401k, there's whole reasons why we don't want to move money out of your 401k to like an IRA. But if you're moving from job to job and you're moving it from 401k to 401k, then that's fine, because you're in the 401k ecosystem. But if you decide you're working with a financial advisor who's none the wiser and says, yeah, roll that money, that old employer money over to me, we'll put it into a traditional IRA so I can manage it and I can get a fee. If they're doing that to you, you want to probably run out of that room and letting everybody else know, maybe don't go in that room and talk to that advisor, because what we want to do is make sure that we're making good educated decision. Just because you left an old job doesn't mean you should move the money to your advisor, because they don't have the tools, unless they also manage your 401k plan, to be able to make sure that we don't run into future tax situations. This particular conversation, this is too much to go into. If you're interested, look at my LinkedIn page or look at my Instagram. I made a post or I made a video about after-tax money, reverse rollovers. It's a whole thing. It takes forever to undo, but it is undoable. But you may just want to keep money in the 401k ecosystem, make your life easier. So to recap, rollovers can make your life simpler. I know I just talked about a whole bunch of confusing stuff, but in general, I'll say 98% of all rollovers are calm procedures where we're just following the rules. We establish the new account, we contact the new company, we contact the old company, we wait, the money gets into the account, we're all good. But there are some things that you want to consider, which is why we always suggest talk to a professional, see what they say about the matter, and then you can make the best educated decision for yourself. But just because you left an old job doesn't necessarily mean that you have to move it. One of the things that you didn't cover in this particular presentation is the fact that many 401k plans, you don't actually have to move. You can just keep your money there, unless you're under a certain balance restriction, like sometimes it's $5,000 as an example. So if you've got like $1,000 there, you might get a letter from your old employer saying, hey, we're kicking you out of the 401k, you need to find someplace to put it. If it's over $5,000, you won't get that letter. You might get something from the 401k company that says, hey, these are your options, but they're not actually kicking you out of anything, because they can't, because the plan can't kick you out. So unless they change their rules. So in short, if you're thinking about doing a rollover, hopefully this provides a little bit more background, a little bit more color commentary in regards to what you could be looking out for. Some reasons to do it, some reasons not to do it. Again, the general guidance is if you've ever got questions, for example, you can reach out to myself. There's my contact information. John Biedenstein leads our 401k team, and so he can be a good resource, and so can Alexia Keel. Both Alexia and I have worked, and John for that matter, we've all worked at record keepers. I used to work for Nationwide, so I know firsthand, what a 401k rollover takes and what we do on them. So if you have any questions for us in regards to that, we hope to be a resource for you. All right. So I'm going to stop there with my presentation, and I'll turn it over to you all if there's any general questions for the group. Again, feel free to unmute yourself. I think we're a small enough group where we can take turns if necessary, or if you're more comfortable, you can always type them in the chat. And while I'm waiting to see if there's any questions, I will give myself a kudos here. This is actually the first time where I've timed myself and I made it 20 minutes. Normally my 20-minute conversations are like 27-minute conversations. So I will give myself some kudos for that today. All right, are there any questions? Nicole asks, is a 403B plan the same as a 401k? Good question. So the Internal Revenue Code, which is where you get 401k, 403B, 457B, and all these letter and number codes, all they are referring to are the types of entities that can establish those kinds of plans. A 401k is a private sector retirement plan. So you all probably here work for private sector employers, and so that's why you're offered a 401k plan. A 403b plan is for non-for-profit organizations, churches, charitable organizations, school districts, things like that. So if you're saying, hey, Colin, I have an old 403b or an old governmental 457 plan when I worked for the city of Smithville or wherever, those types of accounts can be moved between each other. So that's pretty cool. Now, there's even more caveats in terms of whether you should be doing it because every retirement plan system is a little bit different. But the short answer is yes, they are different. And yes, you could consolidate them. They are rollover eligible between them. Great question. I left a nonprofit for a big corporate job. Hey, yeah, exactly. So moving from the nonprofit area into the 401k, yeah, you probably can move that over. Most of the time where we run into more creative situations where we want to pause and make sure we're doing the right thing, Nicole, is when we're moving from a governmental retirement plan, otherwise known as a deferred comp or a 457B. They have very unique benefits. For example, they don't have an early withdrawal penalty. So if you're before 59 and a half, you may be aware you pay a 10% penalty along with taxes on a pre-tax withdrawal. But a 457 plan has no early withdrawal penalty. Still pay taxes, but you avoid the penalty. Doesn't matter how old you are. So for some folks, it makes sense to actually keep your money in the 457 because you avoid an unnecessary penalty. So great question. Great question. Anything else? All right, I've seen pre-tax and Roth accounts. I haven't been offered to open an after-tax account. Why? Well, most of the time, an after-tax source. So again, and I apologize if you get seasick. I'm just going to flash the screen to that so I can go backward to that screen where we talked about sources. So in the early 2000s, Roth became the in vogue option for after-tax contributions. So traditionally, people were contributing pre-tax money to their 401k plan. That means is I'm putting money in, I get a tax deferral. So the money I put into the 401k, it lowers my tax liability in that calendar year. The only other way to put money in was known as after tax. So after tax means I'm paying the taxes on my contributions as they go in. The earnings grow tax deferred, so I'm not paying taxes while it's growing over the decades. But when I withdraw the money, my basis, the contributions that I put in, I'm not paying taxes on that, but I have to realize tax on the earnings part now. But then Roths came in. Roth IRAs first back in, I think it was 98, and then Roth 401k sometime in the early 2000s. Once Roths became the option, if you're not familiar, Roth, same idea with after tax. I'm putting money in, I'm paying the taxes as I put the money in, but I hold the account for at least 5 years, and I'm 59 and a half or older when I withdraw it, and then I don't pay any taxes at all on the earnings. So again, on an after-tax account, I do have to pay taxes on the earnings. So once that came about, many company plans said, oh, well, what's the point of offering after-tax anymore? We're just going to offer the Roth option because for all of our participants in the plan, that's the better option of the two. After-tax contributions so then kind of faded in terms of their availability, but especially larger organizations where you've got people making, let's say, really good money, after tax is still a thing because after you fill up your pre-tax and Roth bucket, there's that cap in terms of how much you can contribute. There might be an after-tax resource that you can still fund. You don't get all the tax qualified benefits like in the pre-tax money or the long-term benefits of the Roth, but it allows you to put even more money into the after-tax source above the $22,500 or the $30,000 if you're over age 50 this year. So that's the reason why after-tax money is not really a thing anymore. But for some employers, again, that really have people that want to save a lot of money in their retirement accounts, like up to $66,000 this year, or if you're older, all the way up into the 70s. That's why it still exists for some employers. Now, there's testing issues that is way outside the scope of this conversation as to why many plans don't offer the option in the first place. But hopefully that gives you a little bit of a history lesson in regards to why Roth is so popular, why after tax doesn't really exist anymore. Great question. Thank you. What other questions are there? Okay. I'll talk slowly. Thank you again for joining us today. This recording, in case you want to pass this along to anybody, this will be posted on our YouTube page probably within the next week or so. I'll pass it along to whomever sent you the invite to say that it's available. If you found me on LinkedIn or something like that we were doing this today, I'll try to post something just to say, hey, the recording is up in case you're interested. In the meantime, again, if you have questions about a rollover or really anything else that's tangential to money that you'd like to discuss, feel free to give me a call, send me an email. I'll be more than happy to chat with you. If you're more used to dealing with John or Alexia, feel free to contact them. So, last chance. Any other questions right now before I let you all go for the rest of lunch and the rest of the afternoon? Going once, twice. Okay, you are all dismissed. Thank you again for joining me today. Please do reach out if you have any questions.
Thank you.
Thanks, everybody.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.